Now that you have a good or somewhat of a good understanding of a stock, should you invest in a mutual fund or an ETF? I'm only going to go over index mutual funds or index ETFs. You'll have to do your own research about the actively managed funds because I'm not here to sell anyone's investment products. An index mutual fund or index ETF tracks the performances of a specific market index or benchmark like the S&P 500, Dow Jones Industrial, Russell 2000, and many more. And neither index mutual fund or index ETF is trying to beat the market, but instead they just ride with the market. If the S&P 500 goes up, then the index fund will also go up. If it comes down, then it will also come down. So let's do a detailed comparison between some of the index funds. So when I first buy an ETF, there's no minimum initial investments like the mutual fund. Some index mutual funds like Schwab and Fidelity don't even require minimum investments, but Vanguard index mutual funds will require say $1,000, $3,000, and sometimes $10,000 or more to open an index mutual fund. It just depends on who your broker is for your Roth IRA, HSA, or taxable brokerage account. And fractional shares, they're limited to certain brokers. And keep in mind that these rules are subject to change depending on when you're watching this video. But at the time I'm recording this video, some brokers will allow you to buy fractional shares. And as you can see, many brokers now, not some, are allowing you to buy fractional shares, and some brokers won't. For mutual funds, after the initial investments, your minimum investment needs to be at least $1. So let me give you a quick example. If one share of an ETF is $300, and if my broker allows me to buy fractional shares, that means I could buy a fractional share of 0.1, 0.2, or 0.5 shares if the broker allows me to, right? Half a share would just cost me $150 in this scenario, right? And which is helpful, especially if I'm only contributing $100, $200, or $300 every time. So if I'm just starting to invest and the mutual fund I really want to buy will cost me $3,000 to open, then I would probably start with an ETF first until I get to $3,000. This also depends on the type of investment vehicle I have. And an ETF might be a better option for me if I'm looking to buy it with a specific share price that I have control over. Maybe I don't want to buy an ETF at $300 a share because I feel like it's overvalued. So maybe I want to wait until the ETF drops to 290 so that I can maximize the return. A mutual fund, on the other hand, processes the trade after the market closes. So if I bought $100 worth of mutual funds right now, then the order will be processed after 4:30 p.m. Eastern Standard Time. But I don't have any control over the share price or the net asset value I purchased with a mutual fund. And with the ETF, I could have the option to do the market order or the limit order. If I want to keep things simple, I could just do the market order. So I just buy shares with the best current price without complicating anything. If I want to buy an ETF at a cheaper price, I could buy 10 shares for $280 in limited price order, which would cost me $2,800. It's really just up to my investing preference. I could even submit a limit order of between 60 and 180 days, depending on the type of broker I have. The downside of doing a limit order is that the share price may never come down to $280 within the time period that I dictate. If I'm investing it for the long term, I just stick to the market price. But if I'm just buying an index mutual fund, and I'm going to use a Vanguard S&P 500 index mutual fund as an example, I could just put the dollar amount in here without worrying about how many shares I want to buy. If I had $200, but the S&P 500 share price is $400, then Vanguard mutual fund will automatically calculate my purchase price to 0.5 shares. So the only downside of a mutual fund is that I don't get to dictate the share price because the trade execution doesn't happen until after the market closes. So I'm going to get the same share price as everyone else who bought and sold the same mutual fund on the same day. And if I'm the type of person who wants to set up automatic investments every week, every 2 weeks, or every single month, then I wouldn't choose any index ETFs because I can't make automatic investments or withdrawals. Some brokers might allow you to, but most brokers don't, right? Unless you have something set up with your broker for the ETFs. With index mutual funds, I can set up automatic investments and withdrawals in and out based on my preferences. It is one less step I need to worry about if I have my automatic schedule set up, right? So when should you invest with ETFs or index mutual funds? If you really enjoy trading and bargaining for a better share price when the market is open, then doing the ETF might be the right option for you, because ETFs can give you up-to-date information on the share price when the market is open. But index mutual funds only let you buy and sell after the market closes. But if you're looking to invest long-term for your retirement, then index mutual funds could be right for you, because you're not looking to buy or sell when the market opens. And it also makes automatic investing so much easier. When it comes to my taxable brokerage account, I find the ETFs to be much more tax efficient than my mutual funds, because ETFs don't trigger capital gains taxes when other investors cash out. But generally speaking, both index ETF or index mutual funds have been good for my taxable brokerage account, because the turnover rate inside the investment is much lower than the actively managed mutual fund or ETF. So the bottom line is that I enjoy investing index mutual funds in my Roth IRA and HSA, while I enjoy investing in index ETFs in my taxable brokerage account. Is it a deal breaker if I did it the other way around? Of course not. What matters is that I am investing and I am putting my dollars to work.
By the way, I am so fired up to announce the launch of my private FIRE community for people just like you and me who are passionate about investing, saving, and achieving financial independence and exploring different possibilities to retire early. My private community will allow you to connect with me on the platform and get in touch with other like-minded individuals or couples who are just as serious as you are with the FIRE movement. As a member of my private community, you'll get resources like investing, saving, paying off debt, or finding the right place to grow your money.
Now that you have your bank account linked to your investment account and you have chosen the index fund you want to invest in the long term, the next step is to automate your investing. And I know you probably think this is such an easy step to do. Why am I talking about this? But you'd be surprised to find out how many people forget to invest because they don't know how much they need to contribute every time they get paid. So I want to show you this here. And these are the most common paycheck frequencies. And you get paid every 2 weeks, on the 1st and the 15th, or once per month. Bi-weekly paychecks are the most common frequency found among businesses. And about 40% of private businesses and public sectors pay their employees every 2 weeks. So I'm going to go with that. All right. So if you get paid every 2 weeks, you're going to have 26 pay periods or paychecks in a year. In some years, you're going to have 27 pay periods, and that can happen when the number of days in a year is not evenly divided by 14 days. But anyway, that's really some nerd stuff. But if you're looking to max out your 401k in a year, you can use Excel to calculate the maximum contribution limit and then divide it by 26 pay periods. I'm going to drop this for the private community members and the course members. Okay. But what if you're late to the game and trying to max out your contribution in the middle of the year? You can just divide the contribution limit by however many pay periods you have remaining for the year, right? So if you have 20 pay periods remaining instead of 26, then you're going to divide it by 20 and subtract however much that you have contributed so far. That makes sense so far, right? And if you get paid on the 1st and the 15th, you're always going to get paid 24 times a year. So your contribution amount will be slightly bigger, but it will be the same at the end. And it's much better at scheduling. Anyway, and if you're trying to max out your Roth IRA every year from January to December, then you would just divide the maximum contribution limit by 24 pay periods. And that's going to get you to the maximum limit. And if you're trying to figure out how much you can contribute every month, just put the amount at the top here and it's going to calculate it for you. And you're going to find out how much you can contribute in total every year. Investing just $100 a month can make a difference. What you want to do is to increase your contribution little by little if you can't afford it yet. If you get a 5% pay increase next year, then increase your savings rate by, let's say, 3% and use the remaining 2% to pay for your expenses. And these are the investment vehicles that you can automate your savings and investing. And I've been automating everything since 2017. And it's nice to just not worry about it at all. And 401k is deducted directly from your paycheck, and your employer can give you profit sharing or employer match. Your 401k is probably by far the easiest investment vehicle to automate your contributions. The 401k website will ask you to contribute in dollars or in percentages. And if you're looking to max out your 401k contribution, then it is better to just contribute in dollars, not in the percentage. If your paychecks aren't enough to max out the 401k yet, then just do the percentage like 15, 20, or 25%. It depends entirely on your current financial situation. If you have any high interest debt, just do the bare minimum contribution up to your employer match. If you don't get an employer match, then just skip 401k for now, right? And you're gonna have to manually schedule your automatic contributions with your Roth IRA. You have to make sure you have an index fund already invested before you can automate your contributions. Your 401k already has a list of mutual funds to choose from, but you have to make your own selections with your Roth IRA. If you do an S&P 500 index mutual fund, then you have to first invest it and then do the automatic contribution schedule. Your HSA is best if you deduct it from your paycheck to enjoy pre-tax contributions, which include Social Security and Medicare taxes. Your employer can also give you a match if there is one, so be sure to contact your health insurance company about the match. You can also contribute from your personal checking account, but keep in mind that you won't get to enjoy the tax deduction right away if you contribute directly from your checking account. You will have to wait until you file your income tax to get that tax refund. And when it comes to your taxable brokerage account, it works the same as your Roth IRA because you're contributing to it in after-tax dollars. And then your cash reserve, like your emergency fund, annual expenses fund, discretionary fund, travel fund, and other sinking funds to save for a home or a vehicle will come directly from your checking account. It should be very easy for you to schedule your automatic contributions if you have accounts in the same bank. So think of automated investing like automated bill pay. If you know how to set up an automatic payment for your mortgage, cell phone, or utilities, then you can easily learn how to set up automatic investing. You have to remember that every investment vehicle has its own characteristics. Your 401k and HSA can be in pre-tax dollars, but your Roth IRA and taxable brokerage account have to be in after-tax dollars. Automated investing is a good idea for everyone because you're always buying into your investments no matter what the market does. You're dollar cost averaging into your investments based on your paycheck frequency. I'm never timing the market. I am always buying into the market. Okay. And let's just say you have been investing for a while and you log into your investment account and you see unrealized gains and you see another option that says realized gains. This is how you look at your investment portfolio. And this is an example of unrealized gains. This doesn't belong to anyone's portfolio. I'm just using it as an example for educational purposes only. And if you look at the ETF here, this is the ETF. This one here is the total cost basis, or that's almost $8,500. And the market value on the left side here is $82.85. So if you look on the far right side here, it says that there's a total loss of 2.39% in unrealized losses. So this ETF on paper has lost value since the investor purchased the ETF. And if you look at the next one with the mutual fund, the investor's cost basis is $18,600. So that's how much money they put into the mutual fund, right? And if you look on the left side, it has a gain, or the market value is $18,993. So that gives the investor an unrealized gain of 2.12%. Why is it unrealized? Because the investor has not sold anything yet, right? So on paper, the investor has an unrealized gain of 2.12%. That makes sense so far, right? So what do realized gains actually look like? So let me show you some examples. Let's say the investor sold out a stock, ETF, or mutual fund for $7,200, but the cost basis was $15,000. Then the investor has a realized loss of 52%. Yikes, right? Out of that total losses, this investor had both long-term here and the short-term positions. So long-term positions are the shares they held for at least a year. Short-term positions are the shares they held for less than a year. The tax implications are entirely different between these two. So the long-term capital gains taxes, they are taxed at 0, 15, or 20%. Short-term capital gains tax are taxed just the same as federal income tax at 10, 12, 22, 24, 32, 35, or 37%. It's very, very crucial that you know how long you've had the investments before you decide to sell, or you're going to have a headache during the tax season. But what if you sold a stock at a pretty good gain? You put $7,000 into it, and then you sell it for $8,285 with a total of almost 17% in capital gains. But only 3.91% of that is considered long-term capital gains. So that's going to be taxed at 0, 15, or 20%. And the rest of 23% there is in short-term capital gains and could be taxed up to 37%, depending on your marginal tax rate. So again, you have to keep in mind that these are just examples and they don't belong to anyone's portfolio. Brand new investors tend to forget that they don't lose money until they actually sell. If you see something at a loss on paper, please don't be discouraged, especially with an index fund inside your retirement account. Just continue to buy and let the time do the rest for you. You can't possibly achieve FIRE if you're always fearful of what your investments might do today or tomorrow or next week. You have to be strategic with your portfolio to make sure it is going to meet your long-term goal, right? You have to be tactical with your investments to make sure they're balanced based on your risk tolerance. Trust me when I say that my first year of investing was just as chaotic as yours, because I didn't know where the market was taking my investments. You are working hard right now for that money to go into your account so that one day you don't need to work again, because your money is going to end up working for you. Your time is valuable. So don't waste another minute being indecisive due to analysis paralysis. Start investing today, right? And this has been another beast of a video, and I hope you got a lot out of it.